I woke up this morning to see an FT article saying that Jeremy Hunt is planning the biggest shake-up to ISAs in years, and he's looking to use his autumn statement in November to introduce sweeping reforms. So I want to break down what we know so far and why, even though I do think these changes are coming from a good place, I also think the government is going about it in entirely the wrong way, and how some of the changes that are being discussed could be very damaging. Before we get into the specifics, I want to zoom out a little bit and look at why the government is looking to make these changes in the first place. In the UK, we are facing a financial literacy crisis. A recent study showed that 73% of Brits fall below a financial literacy benchmark, meaning that they don't understand basic financial concepts like the effects that inflation has on their savings or how pensions work. As a nation, we are not equipped with the skills that we need to navigate the complex financial world in which we live, which leads to people making mistakes and missing opportunities to get out of financial trouble. Over the last few years, the government has been on a big drive to improve financial literacy and more specifically to get more people investing, which is a good thing and something that I am wholeheartedly behind. Ultimately, that's the whole purpose of this channel, to help people make smarter financial decisions and to get more people investing in the stock market. Investing is not right for everybody, but there are tens of millions of people across the UK who are not investing right now, but they should be, and they are missing out in a big, big way. Because in today's world, there are no longer gold-plated company pension schemes that will look after you in retirement, and relying on the state pension won't get you very far. We need to fend for ourselves and invest for our own futures. But most people don't even realise that's an option. Most people think that investing in the stock market is just gambling for rich people. So if they're fortunate enough to have any cash left over at the end of the month, their only option is to put it in a savings account or spend it. Now, if you are a regular viewer of my channel, you will already have taken the red pill, and you will know that the stock market is in fact an incredible tool that we can all use to build wealth and become financially independent, and how over the long term, keeping your money in a savings account where its value is just being eaten away by inflation is in many ways much more risky than investing. But most people don't know that. The Bank of England recently released a report that said that there is currently £250 billion sitting in cash accounts that pay no interest at all. So that's the equivalent of £4,000 per person sitting in accounts earning zero interest. And there will be many, perhaps trillions more, sitting in accounts that are earning less than inflation. Again, investing is not right for everyone, but there are millions of people that are missing out. Millions of people that need to take that red pill and start investing. That is the problem that the government is trying to solve, and it's a problem that I am clearly very passionate about solving too. So, as I said, I think that these changes are coming from a good place. But of course, when the politicians get involved, things are known to go wrong. The government wants to get more people investing, so it's looking to simplify ISAs to get more people using them. Or more specifically, is trying to get people to move away from cash ISAs into stocks and shares ISAs. And these are some of the ideas that have reportedly been floated. Introducing a lifetime cap of £100,000 on ISAs. Now, this is something that Damien did a video on a while back, but I can't see how that's going to encourage people to use them. Then they're looking at simplifying the lifetime ISA to make it easier to understand, combining cash ISAs and stocks and shares ISA into a single type of ISA where you can hold cash and invest, and then another idea of having a separate ISA allowance specifically for investing in UK companies. Now, I don't want to spend too much time digging into these specifically because at this stage, these are only rumors, and even the people involved have recognized how bad some of these ideas are. So, although we don't know for certain what they will be, we can be confident that come November, there will be changes to ISAs. And it's clear that the government wants to do two things. Firstly, simplify ISAs to get more people investing. And number two, get people investing in UK companies. Now, let's start with that second one. Although I understand why the government wants to promote investment in the UK, I really don't like this. We should not be encouraging people to invest in the UK simply because it's good for the economy. It has to be a good investment for people too. The starting point for all investors should be a globally diversified investment portfolio. And the only way that the government should encourage investors to deviate from that is by offering tax incentives that make the UK a more attractive investment opportunity than elsewhere. These types of schemes already exist through venture capital trusts and enterprise investment schemes that give investors large tax breaks for investing in small, innovative UK companies. But the tax breaks need to be substantial, otherwise no one will bother. Having an ISA allowance specifically for UK companies is not a big enough incentive and will only make the ISA landscape even more confusing. And on the point of ISA simplification, I agree that the lifetime ISA could do with some work, and the innovative finance ISA, whatever that is, we can get rid of that. But other than that, I think that a normal ISA is already as simple as it gets. As one commenter on the FT put it, if you find the current ISA system complex, might I suggest that you should not be managing your own investments? In my opinion, ISAs are not the problem. An ISA is easy to understand. It's the stocks and shares bit that scares people away. You can make ISAs as simple as you like, but if people don't trust the stock market, they're not going to invest in it. Why would someone invest their money into something that they don't understand and to something that they consider to be high risk when they can get 5% in a savings account? The problem is not the ISA. It's the lack of education about investing in the stock market and how, if it's done correctly, it's a reliable way to build wealth and protect your future. The Treasury has said that it is receptive to ideas of how we can make ISAs more attractive. Well, I have two ideas for you. Number one, stop trying to simplify ISAs when there are other areas that are in far more need of tax simplification. And number two, promote financial education. Obviously, I am biased in this, but we need more people like Martin Lewis, like Damien, and like me helping people to learn about this stuff. Financial education is the best way to get more people investing, and we are much better at communicating these messages than you are. So work with us and help us to reach more people. Now, I'm really hoping that this video does end up in front of somebody at government, hopefully before they make any of these changes. So I would be very grateful if you can do your bit and give this video a like so that YouTube pushes this video to as many people as we can.